Now, let's talk about intangible assets, another form of long term assets, but specifically those that do not have a physical substance, and they often reflect legal rights. For example, ownership of a patent gives you the exclusive right to make a particular product or use a manufacturing process. Copyrights serve to protect creative works, and trademarks are the right of protection for a company's symbols or slogans that are part of its brand. Governments give individuals and organizations these exclusive legal rights to incentivize the creation of value in society. The deal with the devil is that we'll go ahead and let pharmaceuticals monopolize the market for a given drug for some period of time. We do this in exchange for their investing in the creation of these drugs in the first place. So, as you can see, different asset categories get different lengths of time for which these rights are legally protected. And whereas physical long term assets are depreciated over time, we use a different term for intangibles, namely, they are amortized. It's pretty darn close to the same concept. They mean slightly different things, and we'll use amortization in other contexts later on. But for finite lived intangibles, they are amortized over the shorter period of their legal life or their expected useful economic life. So, for example, with patents, you might have an exclusive right for 20 years, but companies must determine, perhaps a shorter amount of time, when they're actually going to get the benefit from that exclusive right to make a product or use a process. Same thing goes with copyrights. Obviously, if a creator is still alive and we tack on 70 additional years, that's going to be a fairly long time. But if you purchase a copyright, it's not like you just get to amortize it over that huge amount of time. We do have to have an estimated useful economic life. Trademarks are interesting, however. It can be a little bit more tricky to determine the period where they're going to generate benefits. More importantly, they really can have an infinite legal life because while they might only run for 10 years at a time, they can be renewed indefinitely. So often they are treated as having an indefinite useful life and thus not amortized. Now, there are plenty of other types of intangibles that I've not included here. One final one that I'm going to comment on is just franchises, which we discussed earlier from the seller's perspective during our RevRec unit. But for the franchisee, this right has economic value, and any initial fees they pay to set up the franchise agreement are recorded as an asset and will be amortized over the term set forth in that franchise contract. Now, one critical concept to understand with regard to the accounting for intangibles relates to the differential treatment they will receive based on how a company acquired them. And these two methods we'll consider relate to whether these assets are purchased versus developed internally. When individual intangible assets are purchased from another company, they will be recorded at cost plus any other expenditures to get that asset ready for use, typically legal fees. On the other hand, if a company is engaging in serious research or development efforts to internally develop a patent or trademark or whatnot, these are generally going to be expensed in the period incurred. In other words, they do not show up on the balance sheet as an asset, even if they are extremely valuable. And this is again the result of accounting conservatism. When companies purchase intangible assets, we've got an arm's length transaction to track the value that's being paid. But with research and development expenses, it's a lot harder to apply the matching principle. It's difficult to predict which individual R&D projects are ultimately going to provide benefits at all, and even for those projects that are successful, it can be hard to establish a direct relationship between R&D expenditures and the specific future revenues, which is why the ultimate accounting treatment here is to immediately expense these costs. However, one important exception relates to software development. Later on, we'll discuss why this area gets an exception, but after software intended for external use, in other words, a product that you're selling, after it has reached technological feasibility, you can then capitalize all related costs up until the point that it's released for sale. As you know, we're located adjacent to Silicon Slopes here, and this is a really important accounting rule for the myriad tech companies located here in the Valley. The last intangible asset we'll consider is goodwill. Let's start with the strict definition that it reflects the amount paid to acquire a company above and beyond the fair value of that company's net identifiable assets. In other words, before purchasing a business, the acquiring company is going to engage in some serious due diligence to kick the tires of the company they're buying and evaluate what each of that company's assets and liabilities are worth, again, in terms of their fair value. And even after subtracting the fair value of the business's liabilities from the fair value of its assets, it's often the case that the company will still pay some amount greater than this, and that amount is recorded as goodwill. So, an important question then is, why would a company pay more? Well, as we've just seen, as we've talked about during the semester, some of a company's most important resources are never going to make it to the balance sheet. For example, a well-trained workforce, a company's reputation, customer loyalty. Perhaps merging these companies together will create economies of scale, synergies, or expected future growth opportunities. Honestly, anything that makes the acquirer believe that they're going to earn returns above those attributable to the company's net assets, they might be reasons why they're paying more, and those end up in goodwill. And in terms of subsequent measurement, goodwill is not amortized. It is treated as having an indefinite life, but it is tested annually for potential impairment.